Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by Takahiro Sekido, Chief Japan Strategist for MUFG. It's Monday, April 4th, 2022. Welcome back to the podcast, Sekido-san.
Good to be back.
Always great to have you on. So it was a wild ride across markets in the first quarter of this year, certainly in the month of March. I'd argue that Japanese assets had been spared much of the price volatility we saw in other markets, kind of up until this point, I guess, sort of mid to late March. That obviously changed in a meaningful way. Take our listeners through it.
Okay. The 10-year JGB yield touched the 0.25% upper limit of the BOJ's range for yield curve control operations. The BOJ reached by conducting a series of fixed-rate JGB buying operations. It also expanded purchases of 25-year plus JGBs to control the super long end of the curve. The basis tightened slightly through the end of March, with the exception of 9 months contract, which straddles the end of the year. But more generally, demand for DA has grown because of the crisis in Ukraine and a higher DA, which causes increased DA asset funding. That has caused the DA basis to widen, despite Japanese investors unloading foreign bonds. Between March 6 to 26, Japanese unloaded a net 666 billion yen of overseas securities, while foreigners unloaded a net 7.9 trillion yen of Japanese securities. Both sides were net sellers. Japanese have unloaded overseas medium to long-term bonds for 5 straight weeks as Japanese investors have shifted to short-term foreign bonds and shortened their foreign bond durations for 3 straight weeks. Japanese pension funds kept Japanese stocks from falling further, offsetting foreign investors' net selling for 9 straight weeks. At the same time, the foreigners' net selling of Japan yen bonds increased, particularly due to JGB redemptions.
Yeah, so really nothing positive there with Japanese investors selling overseas securities and foreign investors selling Japanese securities. So that was March and a wild month that it was. I guess the question is, what should we expect in April?
Okay. The 40 years JGB auction on March 29th resulted in the BOJ's announcing a temporary super long JGB buying operation on March 30th. And the increased purchases in the JGB buying plan for April to June on March 31st. For now, the BOJ will likely fight the upward stress from rising US rates with, firstly, strong yield curve control management, and secondly, an abundance of the yen funds following JGB redemptions. Overseas investors may have to rebalance their bond positions as G10 bond yields change amid rising US rates. More specifically, we think that foreigners could rebuild their JGB positions through April and May, given first, the relatively high level of dollar-denominated JGB yields, and secondly, the relatively low risk for JGB rates. If Japanese investors accelerate covering of their dollar asset positions as dollar yen surges, this will cause a cross-currency basis to widen, giving foreigners more JGB asset swap arbitrage opportunities. At that point, Japanese investors will have to rebuild their foreign bond positions after unloading foreign bonds in 9 of the last 10 weeks. In our view, foreign investors may be supplies to support the BOJ's yield curve control operation in April as JTDB is more attractive than US T-bills in dollar terms, and a JGB yield curve is steeper than US Treasury yield curve, we recommend the JGBs to US and European investors managing their G10 bond portfolios in April.
Got it. So the BOJ may have some help here as foreigners come in to buy short-dated JGBs on cross-currency asset swap and longer JGBs outright.
Right.
Very, very helpful. Thank you. So switching topics completely, amidst all this volatility, the BOJ released the quarterly Tankan survey. I have to be honest, I nearly missed it as I was paying attention to all this price volatility. So for my benefit and the benefit of our listeners, take us through the survey.
Okay. The BOJ's March Tankan survey showed that Japanese large manufacturers' business sentiment has worsened to 14 points in March from 17 points in December for the first time in 7 quarters. Definitely, we are left with the impression that while first, sentiment among the material manufacturers worsened more than processing manufacturers because of the commodity prices. Secondly, fiscal year 22 will start off with fairly strong capex spending plans, up 8.4% year-over-year at large manufacturers. Third, the share of overseas capex spending is down to 35.9% from 36.8%. And of course, there is strong concern about higher yen rates to 11 points in March from 5 points in December. And our Japanese exporters' Dalian assumption rate for fiscal year 22 is 111.01. The gap with actual Dalian rates has grown to about 10 yen level. Japanese exporters may restore production based on the more favorable terms of trade, given assumption and actual Dalian rates once supply constraints are eliminated.
Yeah, which I suppose in and of itself is a big assumption here. So yeah, absolutely fascinating. Certainly makes sense that sentiment's down. Given the situation in Ukraine. Yeah, so thank you for taking us through that. I think we're about out of time, but I don't want to wrap things up without getting your outlook across yen rate, spot dollar yen, and yen basis. Take us through it, please.
Dalian hits 125.10 on March 28th for the first time since August 2015, driven up by the BOJ's fixed-rate JGB buying operations and the US-Japan monetary policy gap. But topside is heavy at that 125 level, considered the cruder line, and Dalian retreated to the 123 level on March 29th after Finance Minister Suzuki mentioned the weak yen risks. Dalian then fell further to the 121 level as oil prices dropped. Next week, all eyes will be on the minutes to the FOMC March meeting due out April 6th. We expect the Dalian to trade in a 3 yen range between 121 to 124 with a bullish bias. The yen swap rate curve has been steepening. Upward stress on the yen rates has been pushed back by the BOJ's fixed-rate JGB buying operations and increased purchases of super long JGBs. BOJ's financial market departments, central bankers, they have been carrying out monetary operations in line with the monetary policy board's directions, controlling the JGB yield curve with the same-day fixed rate and a series of fixed-rate JGB buying operations. The BOJ could hold fixed-rate operation after the 10 years JGB auction on April 5th, and an increase of purchases of super long JGBs after the 30 years auction on April 7th. Yen rates will maintain their neutral bias as long as the BOJ controls the JGB yield curves. The Ministry of Finance weekly securities flow data for March 20th to 26th showed that the Japanese investors unloaded a net 506 billion yen of overseas securities, while overseas investors unloaded net 5 trillion yen of Japanese securities, showing a net selling on both sides. The details show that the Japanese investors net purchased 176 billion yen of overseas short-term bonds and 24 billion yen of overseas stocks and investment fund holdings versus net selling 708 billion yen of medium to long-term foreign bonds. Japanese investors have continued to shorten the duration of their foreign bond holdings for 3 straight weeks, amid the market speculation of the faster US rate hikes. Overseas investors were a net seller across all the yen asset classes by 2.6 trillion yen for short-term yen bonds, by 2.3 trillion yen for medium to long-term yen bonds, and by 241 billion yen of stocks and investment fund holdings. Overseas investors trading of Japanese securities were marked by, first, the large scale of net selling during the JGB redemption, and second, 9 straight weeks of Japanese stock selling. The front end of the dollar-yen forward premium is relatively attractive now vis-a-vis US Treasuries. Over the near term, we expect rebuilding of the overseas investors' JTDB positions and a smooth consumption in the TDB auctions, with a 6-month auction coming up on April 7th. Meanwhile, the BOJ has maintained its stance with supplying of base money in line with its overshooting style commitment in buying 2 trillion yen TDBs. If overseas investors rebuild their TDB positions, the front end of the JGB yield curve will decline, and the risk of a surge by dollar-yen will grow. If that happens, the Japanese investors will cover their expanded demand for funding of dollar positions, and dollar-yen basis would widen. Japanese could also carry out their overseas direct investing project early in fiscal year 22, which will also widen the basis. We now see a widening bias for yen basis rather than a neutral one.
Well, there is a lot there, but again, just to summarize, you are bullish on dollar yen, neutral on yen rate, and as you point out, the BOJ rather has been extremely effective in defending its yield curve target. So as they may need to continue to do that, but they've done that successfully so far, and your bias wider for basis.
Right.
Got it. So great stuff, Sekido-san. Thanks again for joining us on the podcast.
Thank you. Thank you for having me, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.